761 million users. Record profit margins. Revenue growing 14%. Net income tripling year over year. So why did Spotify's stock drop 14% in a single day after reporting those numbers? And why is it now sitting 44% below its all-time high? That paradox is exactly what we're going to unpack today. What Spotify is, what went wrong with the stock, and both sides of the story, clearly and honestly. Most people know Spotify as the app on their phone where they listen to music. But as a business, it is more interesting than that. Spotify is the world's largest audio streaming platform, operating in over 180 countries. Its business runs on two engines. The first is premium subscriptions. 293 million paying subscribers who pay a monthly fee for ad-free listening and extra features. The second is advertising, a free tier supported by ads, serving 761 million monthly active users in total. Beyond music, Spotify has spent years expanding into podcasts, audiobooks, and now AI-powered personalization. At the start of 2026, Daniel Ek, the founder, moved to executive chairman, and the company is now led by two co-CEOs, Alex Norström and Gustav Söderström. The stock currently trades around $437, with a market cap of approximately $85 billion, down 34% over the past year and 24% year to date. Now, the question everyone is asking, if the business is doing well, why is the stock down so much? The trigger was the Q1 2026 earnings report on April 28th, and the story it tells is more nuanced than the headlines suggest. The good news was genuinely good. Revenue came in at $4.53 billion, up 14% year over year. Earnings per share of $3.45 beat forecasts by nearly 17%. Gross margin hit 33%, the second highest in company history. Net income reached 721 million euros, up from 225 million euros a year earlier, more than tripling in 12 months. But the market did not care about the past, it cared about the future. And the Q2 guidance disappointed on two fronts. First, premium subscriber net adds fell short of some expectations. Second, and more damaging, advertising revenue declined 5% in reported terms. The ad business is going through a painful transition. Spotify is rebuilding its entire advertising stack around automated biddable programmatic ads, and the transition is creating short-term choppiness in revenue. On top of that, operating expenses are expected to remain elevated for the next 2 quarters, driven by increased compute costs and marketing spend for new features. The market's verdict: Spotify may be more of a steady compounder than a high-growth stock these days. And when a stock is priced for high growth and delivers steady growth, the re-rating is painful. Insider activity amplified the concern, with $12.5 million in shares sold by insiders over the past 3 months. So why are many analysts still bullish? The bull case has 4 clear pillars. First, the profitability transformation is real. Spotify spent years being mocked for its inability to make money. That story is over. Free cash flow spiked 54% in Q1 2026, and margins continued to improve. The company holds 8.8 billion euros in cash with no debt aside from lease liabilities. This is a financially strong company now. Second, the scale advantage is enormous. Only 3.5% of the world's population currently subscribes to Spotify Premium. Co-CEO Alex Norström believes that figure could eventually reach 10% to 15%. Even getting halfway there would roughly triple the subscriber base from today's levels. Third, AI is a genuine differentiator. Spotify's AI DJ feature is now used by 94 million subscribers, driving billions of hours of engagement. Song DNA, launched just 4 weeks before the earnings call, had already reached 52 million users. Spotify's competitive advantage here is built on a proprietary personalization model trained on nearly 20 years of unique listening data, something no competitor can replicate quickly. Fourth, the advertising recovery is coming. Management expects ad-supported revenue growth to accelerate in the second half of 2026 as the newly scaled biddable channels begin to offset the choppiness from the transition. Citi reaffirmed its buy rating on May 18th with a price target of $620, implying roughly 40% upside from current levels. Now the bear case, and it is worth taking seriously. The AI disruption threat is real. Analysts on the Q1 earnings call pressed management hard on whether standalone AI music platforms could eventually compete with Spotify directly, whether large tech platforms could simply offer free AI-generated music, bypassing the label system entirely. Soderstrom pushed back, but the question is legitimate. If AI lowers the cost of creating music to near zero, the entire streaming model could face structural disruption over the next decade. Subscriber growth is slowing. Q1 net adds were just 3 million subscribers, and Q2 guidance calls for 6 million. Healthy, but not the explosive growth that once defined Spotify. The platform is maturing, and in maturing markets, valuation multiples compress. The pricing experiments are stumbling. After a 6-month trial, Spotify eliminated its Premium Lite option and reverted its standard plans to previous pricing, a sign that the company is still searching for the right tier structure and encountering consumer resistance in some markets. And the valuation is not obviously cheap. The current PE ratio stands at 35 to 45 times earnings, indicating a premium valuation compared to historical averages. Analyst price targets range from $414 all the way to $800, an enormous spread that reflects genuine disagreement about where this business is heading. That kind of divergence is a signal of real uncertainty, not just noise. Spotify is a company going through a genuine identity shift. It was once a high-growth disruptor that couldn't make money. Today, it is a profitable, cash-generating platform with nearly 800 million users, but growing more slowly than investors once expected. The shares have declined approximately 17% over the past year, despite improving financial performance, suggesting a disconnect between operational execution and market valuation. Whether that disconnect is an opportunity or a warning depends entirely on how you answer two questions. Will AI disrupt the streaming model before Spotify can adapt? And is the advertising transition a temporary speed bump or a structural problem? Index box. Those questions do not have obvious answers today. What is clear is that Spotify is a very different company from the one Wall Street was pricing 2 years ago, and the market is still figuring out exactly what it is worth now. Hit like if this helped you understand what is happening with Spotify, and subscribe for the next deep dive. This video is not financial advice. Always do your own research before making any investment decision.